Welcome back to another episode with Dividend Talks. If you are new, make sure you hit the subscribe button. Otherwise, let's jump straight in as we have a lot to cover. Today, we're going to be talking about BTI, British American Tobacco PLC. We're going to be running this stock through our stock valuation system, looking at that intrinsic value, seeing whether or not it's at a buy, what our acceptable buy is, with a margin of safety, and compare that to Wall Street's price forecast to see if it is undervalued dividend stock. We're then going to be running through our metrics and other additional information. So, for those that do not know, British American Tobacco PLC is a British multinational company that manufactures and sells cigarettes, tobacco and other nicotine products, established in 1902 and headquartered in England. And it is currently the largest tobacco company in the world based on net sales. So before we jump straight into looking at these figures, these are the current products, the main products of BTI. As you can see, there are some brands here that you may stick out, like Lucky Strike, Camel, and there may be some other ones that are lesser known. However, this is their main portfolio of products. Now, what we want to do is we want to look at this graph. So we're looking at the 10-year graph currently, and as you can see, the stock has declined 36% over the 10 years in more of a declining format. Not something we typically like to see. However, we want to find out whether or not this stock is currently trading at a discount and if there is any value. So the forward PE is 9.26, the earnings per share 3.81. And something that investors will like a lot is this high yield of 7.54%. Now, I know people are probably screaming right now that could this be a value trap? So that's what we want to understand. Now, it's currently trending towards the lower end of the 52-week range, currently trading at $35.28, and we kind of want to take a better look at this stock. Year to date, it's down 12%. So, is British American Tobacco a stock we should be considering in our portfolio? Let's find out. As mentioned, these are some of their better known brands. Now we want to take a look at this, which is very important, is the dividend safety. So as mentioned, the dividend yield is 7.61% and the dividend safety score is 45. Now this here says borderline safety. We're going to take a look at all of this information in the next few slides. As mentioned, we're going to run it through our stock valuation system. So let's keep moving. So dividend safety of 45, what does this mean? So essentially based on the dividend safety score here, it's between 41 to 60, so it's borderline safe, meaning there is a moderate risk of the dividend being cut. Now, obviously we need more information for us as investors to understand whether or not this is something that is likely to happen, as we do not want to be investing in a company where there are dividend cuts such as AT&T and possibly Triple M. However, those are companies we can value and look at later. So the dividend growth, as you can see here, the last full year was 1%, so not the highest as you would expect for a yield of 7+%. Over the last 5 years, 4%. Again, it is very slow growth, and we're going to look at this in a bit more detail over the next few slides. So the dividend yield is trailing at above the 5-year average of 7.13%, so 7.61%. Could signal it is undervalued. However, we can see here the forward PE is trading slightly above the 5-year average of 8.8. Now, in comparison, we're looking at consumer staples of 22.4. British American Tobacco is trading at 9.3. However, when we run it through our stock valuation system, we're going to look at companies in similar industries. So we need a bit more information to analyze this number. One thing I love to see is the 52-week price range towards the bottom here at 35.28 with a 52-week high at $45.21. Now, very, 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 very important is the free cash flow payout ratio. If you haven't seen my previous video on my 7 golden dividend metrics, this is one of the most important. We want to see if a company is able to pay out the dividends over time and if we can see dividend growth as a possibility with lower payout ratios. Now, here we have 85% preference for tobacco companies. I personally like to see below 60%, and as we can see over the last 5 years, it has been well below 60%. So in my opinion, this looks good. It looks like management have been able to bring that ratio lower from 2017 down to 2022 and the forward 2023 forecast. So for me, this is very positive, and it looks like management are turning this into what could possibly be a good business to invest in. However, we need more information. Now, sales growth, this could indicate some cyclicality, where there are some years where there is negative growth and some years where there is positive growth. However, what I quite like to look at is the total sales here. If we look at 10 years, the sales for British American Tobacco has gone from $15.3 million to $27.7 million over that 10-year span. So that is great growth in my opinion. If we're looking at purely the last 5 years, from around 24.5 million to 27.7, that's around 10% growth in revenue. Now, this is something that I would be honest, you would be expecting a bit more growth. However, for a company like BTI, you need to understand what kind of business you are investing in. There is high yield, but there is not that growth that you would expect in other stocks such as Microsoft and Apple. So one thing just to consider. Now, as we move on, another thing which is quite important is the shares outstanding. Usually companies return excess cash to shareholders by buying their stock when they believe it to be undervalued. Now, there's the opposite end of this, which is companies essentially issue shares to fund growth projects, and as you can see, this is what BTI have done. The share outstanding are increasing as opposed to decreasing. However, is this something we need to be worried about? Well, let's continue and find out. Return on invested capital, again, one of the 7 key dividend metrics. I personally prefer it to be over 10%. As you can see, 10 years ago, 2013, it was quite high. It started to decline, and 2016 hit 6%. However, if we look from 2017 onwards, it looks like this is increasing from 6% to 8% currently in the last 12 months. So it is increasing. It's going in the right trend. However, we'd like to see that number above 10% in my opinion, but we could say that management are helping this, and it's something that I personally would keep an eye on, but I think it is quite positive, as we can see that management were able in the past to have this ROIC figure above 10%. Now, the last piece that I would like to just discuss is around debt. So if we look on the left, the net debt to EBITDA, earnings before interest, tax, depreciation and amortization, is essentially the number of years a company would need to pay off all its debt. Now, typically we like to see below 3 for tobacco companies, and if we take a look at the last 5 years, this has been above 3. However, it has been declining, and the forward net debt to EBITDA is around 2.78. So in my view, it looks like management are doing quite well, and if we can see this trend continue, not only in the net debt but also in the other metrics that I mentioned, this could be a good stock to invest in. However, we do need to run through our stock valuation system to see whether or not this stock is trading at a discount, as we like to buy undervalued stocks. And also bear in mind that the yield is very high at 7.61%, so it's not something you typically see. So we want to make sure that we're not buying into a value trap. Now, the last debt metric we want to look at here is the net debt to capital. So how much of the company's financing is from debt as opposed to equity. So if we look, for example, in 2020, 0.39, this essentially means that 39% of the company's financing is in relation to debt as opposed to equity. So that's an example. So ideally we like to see below 0.5. As we can see from 2017 till now, this has been trending in a downwards, which is very positive. We like to see 0.34. That's very, very good. So in terms of the debt metrics, my takeaway is that it's positive, and we'd like to see this positive trend continue with management. So I quite like this. We're going to move on to our stock valuation system to see what price we believe. However, before I do, I'd like to just shout out to the Retire Early guy at Retire Early for sponsoring this video. Please do go ahead and follow him for information on finance. Lots of wealth of information provided, and do follow at Retire Early guy. Now we're going to jump into our stock valuation system. If you don't know this, we're going to run through our 4 different valuation systems, and we're going to come to our overall intrinsic value, and we're going to pull out what is our acceptable buy price based on our margin of safety. So we will start with Graham's valuation, which is essentially the earnings per share times 7, which is the PE of a company with no growth, plus 1 times the growth rate projected, times 4.4, which is the average yield of corporate bonds, and then divided by Y, which is the the current yield on AAA corporate bonds, which is currently 4.21. So we've inputted the EPS, and now I've gone for 9 as the growth rate projection. Wall Street analysts are targeting 10%, so I've been a bit more on the conservative side, and that is just a note I want to mention throughout the video on this valuation system. I have personally gone on a more conservative level. So this gives the stock intrinsic value from Graham's valuation at $68.06. And as you can see, the stock is currently trading at $35.28. So this shows that there is undervaluation. But like I said, we want to be able to go through all valuation methods and come to our intrinsic overall average value. Now, the multiples valuation method, we're using companies in a similar industry rather than the consumer staples that we saw earlier, where if we go to our slide, 22.4 was a bit high. We're looking for specifically in the industry that British American Tobacco are in. So if we go here, we've got Philip Morris, Universal Corp, Altry Group, and Turning Point Brands. So what we do is we input their stock price, their earnings per share, and we come to the PE multiple. We want the average PE, which is 12, again, significantly lower than the consumer staples sector, and we want to multiply this by BTI's earnings per share. So this gives us $49.56. Again, significantly higher than the current trading price of BTI. So these are all positive signs for undervaluation. Now we want to move to the dividend discount model, which is essentially the value of next year's dividend, so current year times by the growth rate, divided by the constant cost of equity capital minus the constant growth rate in perpetuity. So I've input in the yearly dividends for the last 5 years plus the current year projection, and as you can see, there have been positive dividends growth rate. However, there is also a small negative here. Now, essentially, we have got the average growth rate of 2.04%. As I mentioned previously, I like to be a bit more conservative, and I've gone for 1.5%. So this is a bit on the conservative side, as I've mentioned, and this comes to 37.89 on the DDM model. Again, 37.8, it's still trading lower than our forecasted. Now, our last method is the discounted cash flow model. What we essentially want to do here is get the free cash flow for the last 10 years, work out the average growth rate, and then find the future free cash flows, get to the present value of future free cash flows, add our cash, subtract our debt, come to our total equity value, and then divide that by our shares outstanding to get to our DCF price. So just very quickly running through what we have done here, the average growth rate is 12.41%. Again, I've used a more conservative figure of 6%, again lower than Wall Street analysts, but I want to have more of a conservative approach. And then this comes to $246,000 in our future free cash flows, the present value including the terminal value. This gives us a DCF price of $68.92. Now, there is a trend going, as you can see. BTI is trading at significantly lower than the price that we are projecting to be based on the DCF model. Now, what we have here essentially is our different valuation, which is pulled through. And we are now going to get to our intrinsic value, which is the average of these 4 methods at $56.11. Now, what we have here is the current price of $35.28. So there's a $20 difference. Now, margin of safety, it can mean something different to everyone. For me personally, I like to hit a 10% margin of safety because I already put conservative numbers into the system. So if I put 10% here, this is saying that our acceptable buy price for BTI is $50.50, so it is a current buy. Now, I know there are people who are even more conservative and would go 20%, and based on 20%, it would give you $44.89 as your buy price. Still a buy. And if we look again at the graph, it's downward trend, so could this signal that this is an undervalued dividend stock. Now, I'm just going to put it here just to show people that even with a 30% margin of safety, it is still a buy. The last thing I want to do is just to ensure whether or not our intrinsic value is in line with what Wall Street forecasts the price should be, just so that we know if we're on the same lines or not. And it's not drastically different. As we can see, Wall Street price forecast $57.34. Through the method that I've shown you is $56.11. Now, all I want to say is that this is not financial advice, so please don't take anything I say. This is purely for entertainment purposes. If you enjoyed the video, please do like and subscribe, as it really helps the channel. And if there is any comments, please put it in the below, as I will respond, and let me know if there are any other stocks you'd like to be analysed. Otherwise, thank you all and have a very good day. Bye-bye.